Well, yo. Welcome, my good people. Welcome to Keep It Thorough Thursdays. Back again with another real dope episode. Episode 43 to be exact, creating an investment strategy. It's your boy E Double.
Yo, what's up, good people? Cedric Lavelle. And yeah, man. Getting closer to that 50 mark. Got seven more to go.
Well, 52.
Well, 52. I'm just saying 50 just seems like a
I feel you.
significant number. You know what I'm saying? 50 just shows like, oh, okay, we getting over that threshold.
Yeah, no, most definitely.
But nah, it's cool.
Well, so really, the point of this episode, right, is I think most people are interested in the concept of investing, and most people just really kind of don't know where to start, right? And by like outlining a couple of different things, I guess some traits, some characteristics that people may be able to relate to or align with, it may help them with, actually creating that investment strategy, and makes it a little easier to attack, right? Because as we talk about all the time, if you don't have a goal or if you're not working towards something, then you know what I mean, it makes it very hard to like make some progress. So
right,
by having a plan, or in this case, your plan is your strategy, your investment strategy, it'll make you be more successful with investing.
Yeah.
So with all that being said, let's go right off into it, right? So knowing the play, the importance of strategy.
Right.
Go ahead and let you take that, Sid.
So knowing the play, if we take a look at it in a sports context, I've done my time with playing sports, but I like to make a lot of sports analogies when creating concepts. So I look at investing a lot like a play call, right? And with the play call, there's strategy behind it, there's intent behind it, there's a lot of moving pieces or moving players that have a responsibility to help and lead to a specific outcome, whether it be getting a first down, whether it be, getting a touchdown, whatever the case may be. And it's similar like that with your investment strategy. You have different things within your portfolio that are meant to do certain things and contribute in certain ways. The way that you approach the market should definitely be intentional. You should have a reason for why you do certain things and be aware of what's going on. So when creating an investment strategy, it's a lot like using a play in a game, whether it be, football, basketball, whatever the sport may be, but it's a play call, right? And so with investing, it's just methodical decisions that's meant to lead toward winning, right? Anytime that you get into the market of investing, you want to win. You want to win big, and you want to win as often as you can. But just like E just said, in order to get to that place where you are winning and you are seeing results, it's going to take strategy. It's going to take a plan. It's going to take goals that you have to map out, right? So your playbook just becomes your strategies toward those favorable outcomes. It becomes what you use and what you do that allows you to really have structure in your investment strategy. It keeps you accountable. It keeps you in line. It keeps you moving towards something because you have a visual. And then in addition to that, you have certain steps that you're being able to take in order to get you there. So 3 quick things that you want to know as it relates to creating an investment strategy. So 1, understand the impact of emotional investing. And so you hear a lot of times when it comes to investing, you got to take your emotions out of it, right? A lot of people can be very emotional when it comes to investing. And that's a very dangerous place to be in, because if you're acting off of emotion and not with logic, or with reason, you can really get yourself in a situation where you're making mistakes that can be very costly. So you want to
Hey,
avoid.
another term for that, right, is FOMO.
Yeah,
Like, so the
fear of
fear of
missing out.
missing out, which a
Absolutely.
lot of people got caught up in that with certain crypto investments, right? Where they, you know, news headlines hit, people making X amount of money. This is, this particular, or not even just crypto. It happened with stocks too, with the whole AMC and GameStop
Right.
short squeezes and all that, right? Where people like, oh, they're making all this money and doing all of this, and then people hurry up and hop in, which is
Right.
an emotional decision because you know nothing about what's going on with these two companies or these cryptos, and then you lose out. I'm gonna just tell you straight up. Whenever you hear those type of stories and those type of big wins, it's already too late.
Yeah.
You know what I
Yeah.
mean? It's at that point,
Yeah.
it's already too late, and you got to try to catch it on the next go around.
Right.
Because what happens is at that point, all the people start coming in, and then all the people who already been in, they're gonna start
They start
selling,
coming out.
which is gonna
Yep.
cause the price to drop, and you're gonna get caught with in what they call holding the bag. You
Yeah.
know what I mean? You get caught holding the bag, and then you either gonna take your loss or you gotta hold now for a real long time until it right
Just try to
size.
gain it back.
Yeah, yeah.
Yep. Yep. So yeah, man, you want to take the emotions out of it. That way you can think with logic, good reason, and really have a structure. And that's why your creating an investment strategy is important, because if you become a disciplined investor, you're going to stick to the strategy that you put in place while you're investing, right? So if your strategy tells you not to get into any type of investment where there's a frenzy around something particular, a disciplined investor is going to stick to that and not be sidetracked or get distracted by some of those things that may potentially happen, because it always happens, right? So the second one is, what works for one may not work for you too. And so with that, it's just understanding that obviously what may have worked for somebody else may not work for your situation. Their investment strategy may be totally different from your investment strategy. So you want to be very cautious of trying to be like a copycat investor and thinking that you can just look at what somebody else is doing and do what they're doing, right? Especially now with knowing all the details and knowing all the ins and the outs and the reasons and the potential gains that they're looking to get, or how long they may have had an investment. Like, you don't know all those things. So really looking at things from a surface level is never an angle that you want to take when it comes to investing, because you can make some costly mistakes doing that.
Yeah, and there's a lot of different variables, man. Like time in market versus timing in market, which is
Right.
very important, right? So you can buy the exact same stocks and try to mirror what somebody else has done, but their timing into the market is at a way different time than when you got in the market, and
Yep.
they could have bought at a way different price point, which puts y'all in two very different situations, right?
Right.
And then so timing in market is the time in which you got in the market, and then time in market
Yeah.
is the amount of time
Which you
you've
spent
been
in it.
holding
Yeah.
that stock, right? So
Absolutely.
those matter.
And yep. And then the last one is, be open to change routes if ever needed. So obviously within any market, when it comes to investing, whether it's in stocks, bonds, mutual funds, ETFs, whatever the case may be, there's always highs, there's always lows, there's always ups, there's always downs. So just being aware of how the market is moving and adjusting your approach to the market will be beneficial. Now, you don't necessarily have to go away from your strategy, but you definitely want to be flexible within your strategy to take advantage of opportunities that may come up that may not coincide with what particularly you were initially doing, but it may be an opportunity and a smart investment to make towards something rather that may be a favorable outcome for you, right? So understand that as the market change, you may need to change your approach towards certain things, but always do your due diligence. You know what I'm saying? Do your research, learn as much as you can, be an active participant in your investing rather than just putting it on a person to do it for you. it's always good to be knowledgeable of just certain things. That way you can at least speak the language and have an idea of what's going on and where your money's going. You know what I'm saying?
Hey, the more you know, the more you grow.
Absolutely.
All
It
right,
is.
cool. So moving on to the next section, right? So forming your character. Before I get into these 4 different investing styles, and I want to say this too, there's more than 4 different investment styles. We just picked 4 that we thought were pretty common and that, you know, most people could relate to. But before I even get into those 4 styles, I want to talk about 2 different investor categories, right? That all investment styles fall into, and that's the active investor and the passive investor, right? And so the active investor is just as it says, active. They're very active. They pay attention. They watch what's going on, you know, and they're actively involved. The passive investor, very passive. They typically make the investment, kind of fall back, don't really pay attention day to day, and you know they're just passive with it. Neither one of those methods are wrong. You know what I mean? It all comes down to time. You know what I mean? The amount of time that you want to put into it, and then the type of investments that you're making, right? Um, I was when we were creating this, I kind of was leaning more towards like stock type investments, but those aren't the only type of investments, and these apply to more than just stocks, right? So if say you're investing in real estate, right, and it's like your first rental property, you really don't want to be a passive investor. You want to be an active investor. You want to pay attention. You want to learn as much as you can. You want to check in on your tenants, make sure everything's going as it should, make sure they ain't destroying your property. You know what I mean? You want to be an active investor. But now once you get a couple, you know, investment properties under your belt, you hire you a management company, then you can kind of be passive. You know, you've done your due diligence, you've done your work, you know, the management company you hired, you know what they're capable of, you know, they cross all their T's, dot all their I's. So then you can kind of be more of a passive investor when it comes to some of those. But again, active and passive, there's not a right or wrong. It just depends on your time that you have that you want to invest into it, and then the type of investment, right? So with that being said, I'm gonna go ahead and get off into the investment styles, right? So the first one being the busy investor. So this is someone who is locked into markets, pays attention to all the ups and downs, which leads to buying and selling frequently. When you hear day traders, they are the perfect example of a busy investor. They pay attention to the market constantly, right? And then busy investors also, they're not just paying attention. When I say that they're locked into the markets, I'm not just talking about stocks, right? They're paying attention to everything, you know, ups and downs and all type of equity and gold, real estate prices, you know, how the economy's doing. They're just paying attention to everything that could potentially affect any of their investments, right? So that's the busy investor. Some people also would consider them to be a little bit obsessed, right? Next one is the casual investor. And some people will kind of, I guess, I don't want to say confuse this, but you can also say the passive investor, right? Which the casual investor falls under the passive category. But someone who buys and holds, but does not pay much attention to the day-to-day movements, typically focuses on safer investments, right? Where a passive investor won't necessarily just focus on safer investments, right? Whereas a casual investor kind of will, right?
Yeah.
So you can be a passive investor, but not be a casual investor, if that makes sense, right? The next on the list is the cautious investor, right? So someone who is more risk averse, putting security first, and typically weighs all options before making a decision. And the problem sometimes with the cautious investor is they're so cautious and want everything to be perfect that sometimes to them the best decision is no decision, which halts progress and potential, you know, growth opportunities, because you got to be willing to take a risk. You're never going to know everything there is to know. But if you got a list of 10 things that you need to know and you can check off 8 of them, I consider that good enough to make a decision. You know what I mean? And then the last but not least, right, is the informed investor. So someone who takes a more well-rounded approach, they stay up to date by seeking information to fill in their gaps, and then open to feedback, right? So this person, they're not a know-it-all, but they do their research. And
Right.
if they meet someone who's more informed than they are, more educated, you know, more time in the market, you know, more experience, they're willing to listen and, you know, ask questions and get that feedback to make them, you know, a better investor. So those are 4 different investment styles, right? Now, again, some may have sounded negative to a certain extent, I guess, or some may have sounded positive, but none of them are right or wrong.
Yeah.
You know what I mean? It all comes down to your comfort level, right? I'd rather you be a cautious investor than a non-investor.
Yeah.
You know what I mean? I'd rather you be a busy investor than a non-investor. You know what I mean? So there's no right or wrong, you know, and you may start off as the cautious investor and
Right.
then move into the casual investor and then become the informed investor, and then you might be the busy
Be a
investor.
business
You
investor.
want to do day trade.
It all
You know what I mean?
changes.
So like
Yeah.
you may grow and evolve and change, and you know the type of investor that you are as you
Right.
gain more knowledge. But none of them are wrong. So and now what's the impact, right? Knowing the role you want to play in the market will help you with understanding your investment style. By knowing what approach to take, you can achieve stronger results and favorable opportunities. So being able to align with an investment style and, you know, kind of craft your strategy around that makes it easier to, achieve what you're looking for, right? Because
Yeah.
it's very easy to check off the boxes, right? So if your investment style is to be, more cautious, and you're looking at a company's performance over the last 10 years, and it's been real up and down, and you see an opportunity to invest, then you might not choose that investment
Go that route.
because it's
Right.
not a safe investment, right? Like it's been real volatile. Like the company hasn't had steady performance. You know what I mean? But now you look at somebody like an Apple or a Microsoft or a Google or something like that, where it's constantly been
Growing.
trending up. You know what I
Yeah.
mean? Like that's a more safer investment. You know what I mean? So you will go ahead and purchase that. But having that a clear understanding of where you want to be and what type of investor you want to be will help you with creating your strategy and then aligning your moves to that strategy, right?
Goes a long way, man.
No, absolutely.
Goes a long
So
way.
the next and last segment of this, right, is taking steps, right? So actions to consider. Go ahead and let you.
Yes, sir. So there's 4 different actions to consider when it comes to creating your investment strategy. Now there can also be additional things that you may want to add on as you create and build out your strategy. But these are just kind of 4 of the essential things that you want to do in order to have a good start, right? So one would be write out your financial objectives. So like we were saying in the beginning, your goals. What do you want to achieve, and when do you want to achieve it by? Right. So really being very, I would say being very broad in your approach, not really limiting yourself on a lack of knowledge, but really just seeing the market as an endless opportunity for you to take advantage of. Now, obviously, you want to be realistic with your approach and what you're wanting, but just having some goals that are in mind at least gives you a solid foundation that you can build on. It gives you a visual of what it is that you're looking to achieve. And then from there, you can act upon what it is that you have set for yourself, which essentially goes into the next thing. Identify what investment style and approach will best fit you. So just in the previous slide, we went over 4 different characteristics or characters that you can potentially embody as your investment style. So with having that investment style and looking at your goals, you can see how you can align that style with your goals. So if one style requires you to be more methodical, you know that certain things may take a while for you to get to. Or if you're more of you take more of an aggressive approach, there may be certain goals that you can reach a lot quicker. You know what I'm saying? So really understanding what it is specifically that you're wanting to achieve, knowing what opportunities are there for you, knowing what particular investment vehicle that you want to potentially pursue, whether it be something in stocks or in real estate or business or whatever the case may be. There are a lot of different vehicles that you can take when it comes to investing. And those characters really, like Eric was just saying, it goes into to anything. Like you can be informed and take the same approach when you're doing business, right? You can be busy and active and really involved, like he was saying, when you're doing real estate. So just kind of knowing what really fits you. And like we were saying, like there's no right or wrong answer, but it really just matters about you being self-aware. Like what's your tolerance level? What's your temperament like? And those are two big things, those two T words. What's your tolerance and what's your temperament? Like what are you willing to take and what are you willing to risk? But also, what's your mental state like? If things go
Yeah.
wrong, are you gonna freak out and go crazy, right? Are you willing to wait it out just to see the outcome of the situation in the event it's not working as fast as you want it to, right? Because when you're in the market, in a lot of instances, it's playing the long game. Like in many cases, you won't get a quick win, and you may see certain things that go on in the market, but you really have to be disciplined in order to, you know what I'm saying, see the favorable outcome and see the results. And that's going to take a temperament and a tolerance level that's kind of like even keel. You know what I'm saying? Not getting too high on the wins and not getting too low on the
On the
loss.
losses. Yeah.
You know what I'm saying? So those are two key things that you definitely want to consider when it comes to taking action and building your investment strategy.
And then the next two, so do extensive research and speak with professionals, right? And I think this goes back to what Seth was saying about being like a copycat investor, right? You need to do your own research. Don't try to, copy what other people are doing, right? And one of the questions I hate the most is when a person like asks me, like, what should I invest in?
Yeah.
Like, and the reason I don't like that question is because one, you don't want to be held. Nobody wants to be held responsible if you
Right.
end up losing
You lost
money.
me money, bro. You
Right,
told me
right.
to invest in this.
And then two, the reasons I may think something is a good investment may not be a good reason for you.
Right.
You know what I mean? So, and then again, my time in market, right? So I could have been holding this stock for the last 10 years, and you're asking me this 10 years later. So if I recommend whatever stock, like, yeah, I may have made a shit ton of money with it, but there's no guarantee that you will. You know what I mean? So be sure to do your own research and speak with professionals. And even if you can't, well, no, let me not even say even if you can't. If you're investing and you're serious about investing, you should be working with a brokerage. And when I say a brokerage, you don't just go set up an account online and invest that way. I really recommend meeting somebody, having a personal advisor that you can meet with, go over your financial goals, go over your planning, and they can help you a lot. They can send you information on stocks. They have like quarterly check-ins with you, like all of that type of stuff. Typically costs money, but the beauty about that is they don't make money unless you're making money, right? And a lot of people look at that as an expense. I don't look at that as an expense. I look at that as a, I don't know. I don't even know how I would classify that cost.
An investment.
Investment.
I mean,
Yeah, really. That's really what it is.
Essentially get
Hey,
returns.
really, at the end of the day, that's really what it is, right? If you're paying money for something that's making you more money, that's not an expense.
Yeah, it's not an expense.
You know what I mean? So yeah, definitely do your research and speak with professionals. And then there's tons of other information out there, right? So there's like the Wall Street Trapper on Instagram, who's amazing at what he does. There's Earn Your Leisure. They give very good information. There's Aristotle Investments on Instagram. She gives a lot of really good investments. And then the way they present their information is in a way where, like, people like us can, consume that information. They're not using all these crazy big words and, trying to confuse you more than help you. You know what I mean? Like, so very, very good resources everywhere. So extensive research, speak with professional. And the next one is commit to a routine that allows you to consistently learn and retool, right? So the first thing to do is create your goal and create your strategy, right? And then commit to that strategy. And as you move along that strategy and you start making the improvements, then you have to continuously, reanalyze that and make adjustments and pivot. You know what I mean? and then retool, and and keep attacking, keep attacking, keep attacking. Don't ever get complacent, or don't ever get satisfied, right? Because that'll cause you to lose money. You know what I mean? Like, you need to pay attention, right? Now, that doesn't mean be a busy investor where you're watching all the time. Where if you want to do that, do that.
Yeah, whatever works for you.
But you have to pay attention a little bit, right? Like, you gotta kind of know what's going on. So commit to that routine, and yeah, it'll definitely help you. And I'm gonna go ahead and let you get in with the final thoughts, Sid.
Yes, sir. So investing offers the freedoms and flexibilities to living a fulfilling life. Just like any other endeavor that you pursue, taking the right steps to invest involves the proper plan and series of actions, right? And so, when it comes to achieving anything, there has to be a plan put in place. There has to be steps that you have to take. There has to be a process that you implement, and a system that you implement. And I think that obviously that goes for really any and everything, right? If you want to achieve, financial freedom, or if you want to start a business, or if you want to pursue something educationally, or if you want to pursue something physically, whatever it is, whatever endeavor it is, you're definitely going to have a plan, and then you're going to have a series of actions that are after that plan that lead to results, right? And in this case, we're talking about investment. So really understanding what the outcome and what the payout can potentially be, what the possibilities are. Like, if you're a smart investor and you're disciplined and you're doing all the necessary things to make favorable outcomes, you're going to get to where you need to be, right? If you're speaking with professionals, you're doing all your learning, you're retooling when you need to, you're sticking to your approach and not being distracted by certain things that may go on, like, you're going to get to the place and the space that you need to get to in order to get to the goals that you're wanting to achieve. So really just following those simple strategies, knowing what character style really fits you, and then just approaching the market like that definitely will help you with creating your investment strategy, but would also lead to you having some freedoms and flexibilities as it relates to your financial input.
Hey, and I want to add on to that a little bit, Sid. So, to give y'all like an example, right, of like a strategy. I think Sid mentioned. I'm trying to remember
what I said.
I'm trying to remember what it was you said, man. But basically, I know the point that I want to make. But basically, so say you have a plan where your goal or your financial objective, that's what it was. Say your financial objective is to buy a car, right? So say you got your eyes on this car. This particular car costs $110,000, whatever, right? Well, let me go to something. It says $60,000. You got your honest car, $60,000 car, right? And you have these various investments, and now you're up enough in some of these investments where you have that $60,000, right? So a very disciplined investor, right, is like, okay, my goal was to make $60,000 so that I can buy this vehicle, and so I'm gonna pour that 60 out, buy this vehicle. Now, when I say up $60,000, I'm not saying you're taking all of your money out, right? So say you started out with $10,000 in investments, and now you made $60,000, so you technically have $70,000. Still have the $10,000 that you initially invested, right? So, and then a disciplined investor will do that. Take out that 60, go buy the car, keep that 10, and continue building, right?
Yeah.
Now, what a non-disciplined investor will do is, okay, I know I said that I want this 60, but this is riding high right now, so I'm gonna just keep riding it and see how high it goes. Well, the problem is you never can time the market. You never know what's gonna happen, right? So now you up 60 bands. Now you didn't wait it, and now a month goes by, and something like, well, let me not say something like COVID, because hopefully this should never happen again. But something happened
Yeah.
where the market drops, right?
Right.
So
Yeah.
now
Yeah.
that 60 grand you was up, now you down. Or you technically not down because you started with 10, right?
Right.
But now you only up 10
You
grand,
don't see them
right?
gains like you did in the
Right.
beginning.
So now you mad, right? Because it's like, damn, I could have took my 60 and bought what I was trying to do, right?
Right.
That's why it's very important to know what your financial objectives are, what your financial objectives are, and to stick to them, right? And it doesn't have to be necessarily a dollar amount as far as the amount of money you're trying to make, right? It could be a dollar amount of the stock, right? So you can say, like, say you buy a stock at $20. Your goal could be, okay, when this stock gets to $50, I'm selling, right?
Mm-hmm.
And then a disciplined investor, when it gets to 50,
$50, they're gonna
they're
sell.
selling.
Yeah.
You know what I'm saying? And now, what does a non-disciplined investor do, right? Oh man, it hit 50, but it's constantly going up. It's constantly going up. And now there's two sides of that coin, right? I gave y'all the negative side where it drops after. There's also the side of it where you go ahead,
It works
stick
out.
to your discipline, right? And then it does continue to go up.
Yeah.
But you can't like be mad at yourself for making money, right? You still made $60,000. You know what I mean? Like,
Yeah.
you didn't lose. You know what I'm saying? And keep in mind, you still got the 10 that you had in there, so that's still going to be riding up. That's still going to be making you more money, right? But I think that was I just wanted to touch on that on the final thought, man. Did you have anything else you wanted to add, Shane?
Nah, bro. That was it, man. Everything you said was spot on. Be disciplined. That's
Yeah.
what it comes down to for sure. Yeah.
No, absolutely. Hey, well, to round this out, man, we greatly appreciate y'all for watching as always. Everybody who tuned in to the live and everybody who goes back and watch the episode. There's a couple recommendations on the PowerPoint, on the kit when you go check it out. And we'll be back at y'all next week with another episode. And with all that said, if you don't do nothing else, keep it thorough.
That road.
And we'll holler at y'all next time. Deuce.